Hi, everybody. Welcome to the Masters Club podcast. We did it in collaboration with Husby. The first episode is going to be with Sawan. He is the king of mortgages, loans, anything to do with financing. I think you're going to learn a lot of valuable things from him. And we're going to talk about a lot of interesting examples, how people approach us, what kind of situations we have to deal with. From obviously my perspective as an agent and his perspective being on the mortgage side. As you guys know, Husby is number one company for mortgages. We also do have real estate company. So we're here to spill some beans for you and to give you valuable insights into what's going on behind the scenes in mortgages and in real estate for clients who want to finance their property. Sawan, thank you so much, first of all, for being part of this podcast, the Masters Club podcast. You're part of our big team at Husby, and you're very well known in the market. And obviously, real estate market is booming. Everyone is anticipating the crash, or they don't know what's happening. And personally, I encounter a lot of clients who opt for mortgages, or they're looking for financing, their home or their investments. And who better than you can tell us all about it? So I just wanted to know basics, first of all, of what mortgages are, what financing options are available here in Dubai, and who can take it, most of all, because there's a lot of information. Some information is truthful, some of it is not. So we're here to break stereotypes, we're here to break the news and give the truth to the people.
Well, firstly, thank you for having me here, Karina. It's a pleasure. Well, to start off with the type of mortgages, firstly, I'll describe what a mortgage is. Mm-hmm. Effectively, a mortgage is a loan that's secured against a real estate asset, right? There are different types of mortgages available. You've got primary purchase mortgages or resale mortgages available, both for residents and non-residents, employed and self-employed. Mm-hmm. Now, as per the central bank guidelines, UAE nationals can borrow up to 85% mortgage for any property up to 5 million dirhams, and expats up to 80% for any purchase up to 5 million. Mm-hmm. Any purchase above 5 million, the loan to values are restricted by or reduced by 10%. Mm-hmm. And investment properties, maximum loan to values are at 60% loan to value. Okay. You also have buyouts. A buyout effectively is when one moves a mortgage from one financial institution to another. Mm-hmm. The primary reason for buyouts is effectively to get a better mortgage product, right? Okay. It's a pretty competitive landscape, and rates move up and down fairly regularly. So we help many clients move from higher interest rates to lower interest rates. Fixed rates right now are the lowest they've been in the last couple of years. Mm-hmm. You also have equity release mortgages. So effectively, individuals that have cash who've purchased the property in cash, have got unencumbered mortgage-free properties, they're able to release money from these properties, right? Okay. As per the central bank guidelines, this equity release option is only available for either a further purchase within the UAE or for home improvement purposes. Okay. So you can borrow up to, again, the loan to value permissible for equity release. Mm-hmm. You have under construction finance available. Yeah,
I wanted to ask you actually about that. You mentioned primary and then secondary, right?
Yes.
So can you tap into more details about what's the difference, how we can do that?
Yes, indeed. So on primary mortgages, as per the guidelines, the client would have to put in a 50% down payment first as part of the payment plan before the banks can lend the balance 50%.
Does it depend on whether or not the project is at 50% construction, or it doesn't have to do anything with that? It just has to be 50% of payment plan?
No, so many SPAs are construction linked and some are not. Yeah. But so long as the client's able to make 50% of the payment, the balance 50% can be funded by the bank. Now, it's a little bit tricky. I think I want to explain this in a little bit more detail, right? Because until very recently, the payment plans have been heavy on the back end, right? So effectively, you have payment plans where you pay, 30, 40%, even 50% during the construction period. And then the balance, 60, 70, 50% at handover.
Yeah, now it's flipped, right?
Now it's flipped. So in this type of scenario, there is no option for an under construction finance because, like I say, the client has to make the first 50% before the bank pays for the final 50%. And in these heavy back end payment plans, effectively, it's a ready property by the time the finance is required.
Yeah.
And of course, once there's a completion certificate and there is a title deed in place or there is a physical registration in place, then that is classified as a ready property, which then allows you to borrow at higher loan to values.
Okay, so let me ask you this question. So for example, I go and I purchase a property, I put 20% down payment for, and then within a month, I complete 50%. Will I still be able to get financing or no? Or it has to be like at the stage of the payment plan?
No, it's got to be at the stage of the payment plan.
Okay, so I have to follow that schedule.
You have to follow that payment plan schedule. And then subsequent to that, of course, if it's a 50-50, again, that option for under construction finance isn't available. But for that matter, if it's heavy on the front end, say 60-40, then we can still finance the 10%. You've got to be a little bit mindful with that because under construction finance is a little bit more expensive than ready property finance because of the inherent risks.
It's a damage, it's a risk,
So I personally feel that these type of finance options should only be taken if the payment plan is at, say, 70-30 or 80-20, then there is a real benefit. But if it's 60-40, then you only benefit for 10% of that payment plan.
Right. Okay. Understood. And now, if we deal with secondary, so for example, already built properties, right? What are the restrictions? Because of course the rates are quite good compared to other parts of the world. But who can take it? Who cannot? You mentioned residents and non-residents, but I'm sure there are cases that, are different, just a little bit harder to work with. What can you tell us about that?
So look, I guess all banks here have like an eligibility criteria, right? And they have a different type of appetite. Each bank has a different appetite of lending. There are certain common factors such as, restricted industries, restricted nationalities, particularly countries that are under sanction currently. So there are some common factors there. But other than that, each bank has their own eligibility criteria. Some are common, like age, for example. You've got to be a minimum age of 21 to be able to qualify for a mortgage. For employed applicants, you go up to age 65. For self-employed, up to age 70. Now, there are some factors that are subjective bank to bank, like minimum income criteria. Most banks require a 15 or a 20,000 minimum salary. We have options at 10,000 salary, as an example. Two of the biggest factors that banks look at, one of them being the credit bureau report, right? So your credit score has to be good. Banks don't like individuals with adverse credit. So any mispayments, any defaults on liabilities could hinder one from getting a mortgage. Also, the banks here use what you call a DBR or a DSR calculation, which is a debt burden ratio or a debt service ratio, right? So effectively what this is they apply a 50% DBR or DSR. Your liabilities cannot exceed more than 50% of your income, right? So they put together everything, your credit card liabilities, personal loans, auto loans,
cars,
your mortgage, they take all of that, and your monthly payments of all of those liabilities cannot exceed 50% of your salary. The banks use stress tests and things like that. So every bank is quite different when it comes to eligibility. For non-residents, there are only a couple of options in the market right now. However, banks have introduced like these low doc policy mortgages. Every country has a different tax requirement. So these low doc policies kind of avoids some of the tax regulations in home countries and just allows you to borrow with minimal documentation.
So how do you deal, for example, just one of the clients that I dealt with, he was from America, right? And obviously you are obligated to pay taxes. And I think the same with UK, even if you don't reside in UK, you're still, you still need to pay the taxes, if I'm correct, if I remember it right. How does that affect how much they can borrow and what their options are in the market here?
So from my understanding, in the US, you have global taxation, right? So all income, whether earned in the US or outside of the US, is taxable income.
Right, yeah.
And you've got to declare that as part of the application. And US nationals do have to fill out a special form, confirming their tax obligations, etc. In the UK, however, you only pay tax on the income that's earned in the UK.
Oh, okay.
So, you could reside out here, have a portfolio of real estate assets, and not be liable for taxation in the UK.
Okay. So that's a very good perk for people who want to,
No,
keep their money
absolutely.
here and not be taxed on it. Yeah.
Absolutely. But you've got to be a non-resident, of course, of the UK. So you can't be living, if you're living in the UK and you have assets outside, then you're still taxable. But if you're a non-resident, then certainly those taxes don't apply.
That's a nice catch. Yeah, 100%.
Yeah.
All right, perfect. And let's say with everything that's been happening, with the political situation in Russia and Ukraine, we saw a lot of people moving here and, trying to open bank accounts and take out mortgages and buy properties that way. You mentioned sanctioned countries. Which countries would be part of it? Like, for example, right now, is Russia part of it still? Because I remember a year ago it was. But is it possible for them to, get residency here and open a bank account that way? Or can they still open bank account without being a resident?
So you can, clients can open bank accounts being resident or non-resident, right? So in order to service a mortgage, it has to be serviced from your UAE bank account.
Okay.
So you also have, we have many non-residents who own real estate assets out here and have bank accounts out here. So bank accounts is not so much of an issue. However, if you're coming from a sanctioned country, then it could be quite tricky to open a bank account and to get any type of finance in the UAE.
Right.
We do have, we've done finance for many Russians, as an example, who live here. We do mortgages for Iranians, as an example, who live out here. However, if you're a non-resident living in Russia or in Iran, as an example, then you wouldn't be able to qualify for a mortgage out in the UAE.
And just throwing cases out there, because, when I deal with clients, I definitely turn to you and experts such as you who can guide me, because I'm not very well versed in that field. And it's very tricky. There's a lot of underlying rocks and things that people need to know. So, for example, if I have a client, right, and they are self-employed outside of UAE, can you just walk me through the steps of how they can obtain a mortgage here? How can they get the best possible rates and, leverage from financing?
Of course. So non-resident rates start off at 5.25% up to about 6.5%. Like I said, there's limited options available for non-residents.
Okay.
Non-residents right now can borrow up to 60% loan to value because effectively it's an investment property which is restricted to 60%, right?
Right.
And we have a couple of banks who offer mortgages at 60% with minimal documentation. So effectively, all they want to see is the last 3 months' bank statements, and they want to see that there is a certain amount of credit coming into that bank account to be able to service the mortgage,
Okay.
right?
Is the bank account personal or company's bank account, corporate bank?
Personal bank account,
Okay,
yes. So they look at the income that's reflecting in the personal bank account. So a self-employed applicant would have to transfer their some kind of money into their personal account to
Of
be able to
course.
qualify for a mortgage. Yeah.
Okay, interesting. And is there a certain balance or like a threshold?
A minimum of 25,000 dirhams.
Okay, so it jumps from basic 15.
15 to 20,
25,
it goes up to 25.
Mm-hmm.
I believe one of the options is even a minimum of 40,000, but the minimum for non-resident in terms of credits and bank accounts is 25,000.
Okay, and you mentioned also percentages, right? You said 5.2?
Yeah, 5.25,
Five and a
5.24,
quarter.
yes.
Okay, and what affects that interest rate, right? Because it fluctuates a lot of time, and obviously it's different for residents, non-residents. How can we look at that? How can we understand it?
Every bank has a different charging structure,
Mm-hmm.
right? So when I say ranges between 5.25 and 6.5, we've got a couple of banks right now that are catering on these non-resident low doc, mortgages.
Mm-hmm.
One is offering the mortgage at 5.25, and the other one is offering it at 6.5%, as an example,
Mm-hmm.
right? So it just depends on the risk appetite and the type of clients that the bank wants to pull.
Okay.
In terms of resident rates, they're around about 4% currently.
Mm-hmm.
The way that rates move is subject to the way that the U.S. Fed rate moves,
yeah,
right? So
100%, yeah.
we are pegged to the U.S. dollar, and every time the U.S. Moves rates, it has a direct impact on our cost of funds.
Yeah.
So right now we're anticipating that interest rates will be held for the next 6 months. There is a meeting on the 31st of January, and there is a high likelihood that interest rates will remain stable for the next 6 months. And then we're expecting interest rates to drop post the first half.
Why is that?
So inflation in the US has
Right.
been coming down.
Right. They're trying to suppress it and minimize it as much as possible.
Absolutely, absolutely. So as inflation comes down, so do interest rates. And with the figures coming out of the US right now, it looks highly likely that interest rates will drop. So we're expecting lower fixed rates this year in 2024 for sure.
Okay, great. And just speaking, because I also am very interested in mortgages and it's a great way to leverage. There's fixed and fluctuating rates, right?
Variable, yes. Yeah.
Variable rates. What is the difference? Are all like banking institutions offer both, or it depends on the applicant, or it depends on the duration or the amount?
Well, it's a good question. You see, most banks do offer fixed rates. Some offer both fixed and variable rates. The primary difference is, you see, on fixed rates, banks offer fixed rates between 1 and 5 years, mostly.
Okay.
There are some banks that offer 10 and 15-year rates, but a lot higher. So generally, 3 to 5 year rates are the most popular rates currently.
Okay.
Now, a fixed rate is where, for example, you have a rate of 4% fixed for 3 years. That means for the next 3 years, your monthly payments will remain stable
Okay.
throughout the 3 years, regardless of how interest rates move. So if interest rates rise, you still have a fixed rate, which is fixed for that 3 years. They drop, same thing. On a variable rate from day one, effectively, as interest rates move up and down, so does your rate, and so do your monthly payments, right? Also want to mention that for fixed rates, generally because they're only 3 to 5 years and mortgage terms go up to 25 years as an example, then after the fixed rate lapses, it goes on to a variable rate, right?
Okay.
So at that point, many clients look at alternatives because variable rates currently are higher than the fixed rates.
Right.
So they look at an alternative to try and refix their rate for a further 3 years as an example. And that's the buyout that I was referring to earlier.
Amazing, amazing. But buyout is available for both, right? Residents and non-residents.
So right now, and again, a very good question. Right now, the options are only available for residents because there aren't too many lending options for non-residents.
Okay, understood. And just from your experience, obviously looking back at the trends, the history, the way that market fluctuated, what can you tell us about, the type of clientele that come for mortgages? Obviously, in real estate, a lot of people are opting for luxury. Luxury is booming. Do you see more of, investment type of properties and maybe like bulk deals? I don't know people opt up for mortgages for that. Or maybe there are clients who want to finance their luxury property. Have you seen anything like that?
Yeah, so look, as per the trends that we recently looked at, there are more mortgages being taken up on villas than there are on apartments. I think this is simply because of the value, the higher values of villas, and therefore, one may need some assistance in purchasing that and won't be able to afford it outright. So as far as trends concerned, we're also seeing like residents as an example. Today, rentals have gone up significantly, right? And are becoming more and more unaffordable. So you're seeing residents, as interest rates come down, being able to afford mortgages. Of course, mortgages are spread over a long period, over 25 years as an example. So your monthly payments and the interest payments towards that mortgage generally is a lot lower than the rental that one pays. So we're seeing, of course, a lot of resident demand. We've seen a massive increase in non-resident demand. But also we're starting to see a real increase in commercial mortgages. So business owners, of course, they have office space, warehouses, whatever that they're working with. And effectively, all of these rentals have gone up.
Right.
So commercial mortgages have now started to pick up real pace. I expect in 2024, we'll see a huge increase in that space.
Interesting. And is there a difference between residential and commercial mortgage?
There certainly is. So a commercial mortgage, there are different types of commercial mortgages, right? There are mostly are asset backed. You have some that are based on rental income. So an investor owns an entire building. They want to borrow. They look at the rental income. They call it lease rental discounting, as an example. You have businesses that want to purchase office space outright. That can be very different as well. Most loan to values on commercial are restricted to about 70% loan to values, and the interest rates are a little bit higher. So generally, when I say a little bit higher, depending on the type of product, actually quite a bit higher. So you're looking at 2 to 3% above EBOR. The 3-month EBOR currently is at 5.25%. So you're looking at rates starting at 7, going up to 12% on commercial mortgages.
Okay, very interesting. And I want to kind of go back to what you said about villas and the demand and financing properties such as villas, right? Obviously, the trends have been showing that people would like to move into a more spacious property rather than staying in an apartment after COVID, all of that stuff. And 100%, the prices went up. And very interesting thing is, I know that when you're doing mortgage, right, or when you're applying for it, there is a step that's called evaluation, right, of the property. Does the age of the property matter? Because, for example, on Palm Jumeirah, the old garden villas and cove canals are quite old, So does that make a difference on how much the bank is willing to support you, whether it's new or old?
I guess it depends on how old the asset really is, right? So the valuation generally confirms the lifespan of the asset itself, right? So long as the lifespan is long enough for the bank to be able to lend the maximum term on that asset, then we're good. Generally, the evaluations don't really, they do take the condition of the property into consideration, but not particularly the age for the actual value of the property, right? So, as an example, Emirates Living, Meadow Springs, quite old, but there are some really well refurbished properties out there. Similarly with Palm Jumeirah, as an example. So generally, the surveyors take 2 or 3 things into consideration when looking at a value. One is sold comparable evidence, right? So they will look at a similar type of property in that locality and see what they were sold for previously, and that's a good indicator of what the current market value may be. They look at the condition of the property, and they look at the positioning of the property, right? So has it got a good view?
Very
For
interesting.
apartments, that matters more than for villas, but also for villas where it's situated, is it next to the pool or the park, etc., will make a difference on the value.
Very interesting. So it's very similar to, when an investor picks out an apartment for rental yield or something like that. It's very similar, yeah.
And hence you see like properties with a good view
Right.
or recently refurbished are being sold for a higher value than those that are not,
Interesting. So I know I'm going from one topic to another, but there are a lot of questions, right? What happens when you default? So for example, you have a mortgage you've been paying out for, let's say, 5 years, and then God forbid something happened, and for some reason you have to default. What is the procedure then, and what's going to happen?
Sure. Look, the default scenarios, there are hardly any in the market today, right? Simply because we've been in a rising sort of real estate price sort of situation. So if one gets into trouble and when there is high demand for real estate, they'll just opt to sell, right? Sell and settle off the mortgage.
Right.
Really, repossessions really come about when the market is in a downturn, right? And when it's in a downturn, when one cannot afford to pay the mortgage and they're not able to sell the property, then the banks, after a specific period, would aim to repossess or carry out a foreclosure on the property. So you'll have to go through Dubai courts. There are some differences between whether it's a conventional or an Islamic mortgage. It makes a difference. In a conventional mortgage, the bank would repossess the property and then sell it through an auction house, like Emirates Auction, as an example. For Islamic mortgages, because the bank effectively, the bank owns the property, and a lot of the time, the bank stated as the owner on the property. And the way Islamic mortgages are structured, the real owner is effectively leasing the property from the bank. So in case of a default, the bank then has the authority to go ahead and repossess that property or sell that property. Generally, banks in the UAE are quite understanding. If there is a good reason, they're able to potentially restructure the loan, and they will give you some time before they physically repossess the property.
So they're willing to work with you, basically.
Absolutely. And I think we saw that more so during the COVID period, where actually the flexibility was required.
Okay. And have you seen more people opting for mortgages during COVID or now?
No, certainly now, because less people were buying during COVID or just after COVID. So mortgages are directly linked to real estate sales. So if the sales didn't pick up then certainly the mortgages didn't either. Now we're seeing a real boom in UAE real estate, and we're seeing the same in mortgages. It's a demand thing.
Yeah, 100%. So, all right, we talked about mortgages. If we can just run quickly, right, through steps for people who are watching, who want to understand, okay, this is what I need to do. Because for me as an agent, right, when a person comes to me and says, I would like to finance and mortgage that property, it's very important to have pre-approval, right? And not a lot of people understand what pre-approval is, how long does it last for, what does it give you, basically, why some agents, including me, are not willing to show a property or take a serious consideration of the offer before pre-approval is done. So if we can walk through every step of kind of duration, and also step by step of what we need to do to obtain the mortgage and actually get the final offer letter, right? Is that what it's called? From the bank, and kind of move on.
Sure. So look, firstly, I totally understand why an agent would want a client that is either cash, because it's an easy sell, or a pre-approved client. A pre-approval effectively is a guarantee of finance from the bank, right? Subject to the valuation taking place. So the first step would be, I'd like to kind of highlight, I think also working with a mortgage intermediary such as ourselves is super important. Why? Because we've got the full suite of all the banks in the UAE, right? And due to the volume of business that we do with the banks, we can leverage our relationships and we get better terms, rates in many occasions. And we can sift through the client's profile and requirement and recommend the best possible offer for the requirement, right? So the first step would be to get in touch with a mortgage intermediary, such as Huspi. We would do a fact find, understand your profile and requirements. Following that, we'll give you a proposal, giving you a full breakdown of the type of products that are available or the best products for your circumstances. It gives you a full breakdown of the costs, the documentation that's required, and the process timelines, right? Once our advisors pick the right product with the client, we'd have to put in a mortgage application. The mortgage application involves an application, physical application, supplementary documents such as salary certificate, bank statements, KYC
Proof of
documents,
income,
etc. So once that is all supplied, it goes into the bank, and it takes anything between 3 to 10 days to get a mortgage pre-approval.
It's quite fast, yeah.
Fairly fast. Now, there's also digital solutions available where you can get pre-approvals within 3, 4, 5 hours.
Oh, wow.
So once the pre-approval is obtained, you'd have to, of course, sign an MOU for the purchase of the property, which is required to take it to the next step of evaluation that we talked about earlier. Once the valuation has come in, the next step is of course, mortgage final offer letter. The steps do change dependent on whether the seller of the mortgage or seller of the property has a mortgage or not, right? So if the seller of the property has a mortgage, there is a liability letter. The buyer's bank has to pay off the seller's mortgage, get clearance documents. If there is no mortgage, seller mortgage, then it goes straight to NOC with the developer, and then physical registration.
Yeah, and it's very important that you mentioned MOU, right? So for everyone who, the clients, right, and also the agents, I really want to stress out the fact that in MOU, it's important to have a clause, an addendum, right, that it's subject to final offer letter. Because a lot of people, I think, miss that step or don't pay attention to that, and then they sign, and then, something might go wrong or they don't get the same amount that they were hoping for, and that kind of creates a little bit more problems for them.
Yes. And then that generally tends to happen when there is a down valuation, right? So as an example, if one buys a property for $1 million dirhams and the valuation came back at 800,000 dirhams, right? Then the bank will only lend on whichever is lower. Right. So in this case, 800,000. The client would have to bridge the gap between the down valuation and the purchase value. And if they don't have those funds, then that could be a potential default, and they risk losing the 10% deposit that they put down. So having this clause protects clients against any down valuation, or for that matter, if there is a change in circumstances, let's say there's a change in employment, redundancy, something like that, and you're not able to meet the bank's lending criteria, then certainly, that clause will protect a buyer in such scenarios.
Yes, 100%. And for pre-approval, so great, we got the pre-approval digitally or through us, at Huspi. They came directly to you. How long does the pre-approval last? As far as I know from experience, it's around 30 days. Is that correct?
Well, most banks 45 days, some that are 30, and one or two that are 60 days. So it's between 30 and 60 days.
Is it possible to extend it or no?
Not possible to extend, but it's possible to revalidate. And that's quite easy, right? So once you've supplied all the documents at outset and got the first pre-approval, on expiry, they just want to see your latest salary credits through your bank statement, as an example. So long as you can just provide the updated documents, then it's quite easy to revalidate.
Amazing. So another very interesting thing that I wanted to ask you as an expert, there's a lot of talks about, all right, we will take a mortgage, but for some reason, due to salary or, valuation, the mortgage doesn't cover the full cost of the property, right? Or the full 80% or 60%. A lot of people consider getting a personal loan and kind of, backing that up with it, would you recommend it? Is it quite risky? What's the difference between personal loan and mortgage? Who would be benefiting from it, and who would be, at very high risk if they opt up for that?
So look, I mean, one can take out a personal loan and potentially buy a property outright, right, with that personal loan. However, there is a restriction. Central bank has a guideline in place where banks cannot lend towards the deposit, right? So personal loans cannot be used as part of the deposit or a shortfall on the purchase price, right? So the trouble with personal loans, of course, they're restricted to 4 or 5 year term, and you can't borrow as much as you can on mortgages, but you certainly cannot bridge the gap of a deposit or a down valuation through a personal loan, as that's not permitted.
Okay. And are the interest rates differ from mortgages to personal loans? Are they higher, or it's the same thing?
No, personal loans are unsecured.
Okay.
Of course, mortgages are secured. There's an asset. So in case of a
Right.
default, there is
They can just
an option to
repossess it.
repossess.
Yeah.
So the risk on a personal loan is higher, and therefore the
Right.
pricing is also higher.
Okay, understood. And residents and non-residents can take personal loan, or only residents?
No, only residents,
Okay.
because the personal loan is based on UAE income only. And it would be next to impossible to follow up on a non-resident client that defaults on a personal loan.
100%.
However, a non-resident client that defaults on a mortgage, there is still an asset within this jurisdiction that can serve as a suitable security.
100%. So I wanted to talk a bit about more controversial situations. Let's say I'm self-employed, right? And I've been personally getting a lot of clients like that who have a shell company or a company, that they run their money through. However, when they're needed to provide source of income or like any documents for the banks, they're mainly lacking on like audits and, very important official information that's needed by UAE law or bank. Have you encountered situation like this? What would you advise agents such as me and others to do in that kind of situation? Because obviously people do want to leverage and finance it, but however, they cannot do it, or they can, but it's very risky and tricky.
Yeah, it's a good question. I think I'll start off by just giving you a little bit about the criteria for self-employed applicants, right?
yeah.
So most banks would want a trading history of 3 years as a minimum,
Okay.
right? So any new entrants into this market that are self-employed, that don't meet the trading history, would not automatically
Like a
would not
red flag,
qualify,
yeah.
right? There are some banks that would accept like a 1 year or a 2 year trading history,
Okay.
but you would need to kind of complete that trading history. The banks also tend to kind of do site visits, right? So they want to see an operational business, right?
But what do you do if the company is outside of UAE?
So and therefore we can go back to the low doc mortgages that are available.
Okay.
So we take foreign income into consideration, and based on low document requirement, we can extend the loan. But I think one thing I do want to point out that the company has to be legitimate, right?
Right.
And the source of funds has to be legitimate. So any shell company where it's just there, for the
Like
purpose
nominal,
of,
yeah.
then that's again is something that wouldn't pass.
100%. And all right, and we talked a bit about the predictions, right? And the banks and how it's linked to USA. What will you think, or what do you think is going to happen when, obviously we're expecting a huge increase in supply by 2026, 2027, with all the launches that are happening at the moment. All of these properties are going to be delivered. What are the options for people to put that property into the bank and, kind of cash out from it? Because I think a lot of people will consider it depending on, how the market behaves. What is the procedure for that? Is it hard to do? Is it fairly easy? Because, there is something physical there that you can put in the bank, and it's kind of assuring the bank that you're not going to just run off with the money and, default.
So, this is the equity release piece that I touched on just a little earlier. So effectively, for residents who own unencumbered mortgage-free properties, you can release up to the full loan to value.
Okay.
But these funds can only be used for a further purchase within the UAE or for home improvements. Non-residents, unfortunately, don't have that option currently to equity release on a mortgage-free property.
Okay.
The process is fairly straightforward. It's very similar to a mortgage. You'd still have to do a pre-approval. You have to go through a valuation process so the bank understands the value of the asset or the security. You still have to go through the process of a final offer letter.
Right.
The only thing that you'd avoid is the NOC process.
Okay.
Effectively, because you're financing your own property.
Okay, and you mentioned loan to value, right? So in that case, let's say the title deed price says 1.6 million. Is it depending on the current market price, or is it based on the title deed price?
Always the current market value. The current open market value, and that will be determined through that third-party valuation that's conducted.
Okay, amazing. So they can actually gain more if the property appreciated over time.
Oh, for sure. And, we also have instances where individuals, residents have bought a property out in the UAE through a payment plan, primary purchase through a developer. And over this period, whilst the market is
Climbing,
going in one direction upward, a lot of them at handover realize that actually the property value is much higher than the original purchase price, right? So banks at handover are also able to, some banks are also able to not only pay the final payment, but also release equity based on the incremental value of your property over that period of build.
Oh, wow.
Yeah.
That's very useful.
Yeah.
Okay, everyone just take note of that because this is amazing.
Yeah.
All right, perfect. And I guess kind of final thoughts of, you mentioned the interest rates are going to stay stable. Do you predict that they're going to go up a bit in, let's say, 3-4 years? Because, the real estate cycle is approximately 6 years in Dubai, right? In the UAE. How is that going affected, right? Because right now we're climbing up. Eventually, at some point, we're either going to reach correction in prices or a bit of a downfall, which is normal. So what are your predictions for next 4 years? I don't know if you can make it, but...
No, I don't even think the greatest economists in the world can predict that far ahead.
Right.
Generally, look, interest rates are dependent on many macro factors, right? We can tell how the interest rates are moving for a sort of a 12-month period.
Okay.
And this is based on some of the economists and the comments that come out of great minds. Having said that, we've been in an interest rate rise environment for quite some time, and I personally expect an interest rate drop environment for at least the next 3 to 4 years.
Okay.
What happens post 4 years is anyone's guess.
Of course, nobody can predict that.
Yes.
100%.
Yeah.
All right, perfect. Thank you so much, Sawan.
You're very welcome.
Just if anyone didn't understand, we are part of Hasbi, and for any kind of information or if you need a consultation, I will leave all the contact details for Sawan. He is the king of mortgages and loans, and more than welcome to reach out, and I'm sure he'll be able to help or assist with any kind of question. So thank you so much for
You've
today.
been absolutely lovely, Karina. Thank you.